Welcome to a Practice Pro CPD, brought to you by LAWPRO.
Hello, everyone. Thank you for joining us today for this program, Unlocking Real Estate Wisdom. My name is Sean Erker. I'm the legal writer and content manager at LawPro. And thank you very much to everyone at the TLA, Deirdre, Sandra, Precious, Claire, Joan, and everyone else who is involved in putting together these programs. We have a very, very packed schedule for you today. Lots of extremely relevant, fresh off the presses content is how I like to describe it. Right off the top, I'd like to remind everyone that this program is worth 90 minutes of professionalism in CPD, and it is also worth one $50 risk management credit, which gives you credit on your next LawPro insurance premium. We have programs for this material. We have material for this program, and it is in the webinars chat. You can click on the link. You probably also received the PDF for the program materials in your email prior to this. We will be answering some questions during today's program, so please put your questions into the Q&A box. It's at the bottom of your screen in the Zoom. It is different than the chat box itself. We will be keeping track of the questions as we go, and we will try to save some time. At the end of the program, some people are saying that they don't see a link in the chat. We'll make sure that that link goes in there again, just so that you have it. But like I was saying, the Q&A is going to be handled at the end of the program. We will be able to answer some questions, so please put your questions into the Q&A box. I'm speaking to you now from Toronto, which is also where the offices of LawPro and the Toronto Lawyers Association are located. And I want to respectfully acknowledge that Toronto is on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many First Nations, Inuit, and Métis peoples. And Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Now, as this meeting is virtual, we're not all gathered in the same place. So for many of you, this land acknowledgement is not exactly applicable, but we encourage you to take some time to learn about and acknowledge the territory in which you live on. And as a resource, please visit the website native-lands.ca. And at that website, you can search for a location to find the appropriate territory acknowledgement. So we'd all like to recognize the long history of First Nations in Ontario and with the Métis and Inuit people. We thank them and the people who have lived and continue to live on these lands for sharing them with us in peace. Now, for today's program, it's going to be divided into 5 different areas of discussion. First off the bat, we're going to hear from Brendan Fagan about some key takeaways from the recent federal budget and how they might impact the real estate market and real estate practitioners. Now, Brendan recently joined LawPro and Title Plus as the new chief underwriter for Title Plus, and we're very excited to have him lend his expertise to the company as well as to this program. After that, Brendan is also going to be speaking about NOSIs, that's notices of security interest. So he's going to be walking us through what they are, how they impact homeowners, mortgagees, and other clients. After that, we're going to hear from Sophia Vankawala, who's LawPro's communications counsel, and she's going to talk about ID verification and fraud. And the new IDV requirements from the LSO are going to be impacting all of us, and we're still all kind of coming to terms with that and learning about it. After that, we are going to be learning about the CRA's new trust reporting rules. And I just want to mention right now that unfortunately, one of our speakers appears to be running late. And so we might have someone join us suddenly in the middle of a program. Please just bear with us. But we will make sure we have that content covered for you. And finally, last but not least, we're going to hear some from Mark Japadoni, who's a partner at Gallings, and is going to tell us all about the tax must-knows for real estate transactions. So without further ado, I want to hand this off to Brendan, and thank you very much, Brendan. It's all yours.
Good morning. Thanks so much, Sean, for the introduction and for the invitation to speak at today's CPD. As you mentioned, I'm only a couple of months into my career at LawPro, and it's been nothing but great so far, and I'm definitely looking forward to at least another couple of months at the company. Today, I'll be speaking on 2 diverse topics. The first being a few highlights from the federal budget that relate to the real estate market. And the second topic will be on notices of security interest, including the highly impactful legislation the provincial government is working on. With that said, I'll begin with the change in the capital gains tax. As I'm sure most of you know, the capital gains inclusion rate is increasing from 50 to 66.7%, as announced in the 2024 federal budget. There's an important difference between corporations and trusts on one hand and individuals on the other hand. Corporations and trusts will be taxed at the new higher rate from $1, whereas individuals will only be taxed starting at $250,000 and higher. This will have an impact on cottage owners and real estate investors. There have been many articles in the news over the last couple of weeks specifically about cottage owners who are either looking to sell or contemplating whether they should be looking to sell prior to the June 25th effective date of the change. And lawyers may see an uptick in cottage property sales for this reason. The federal budget, as one of its main focuses, had fairness for the younger generations of Canadians. And this is in an effort to make the market, the housing market, more affordable. A couple of the changes announced in the budget meant to assist younger Canadians buying their first home include enhancing the home buyers plan by increasing the withdrawal limit from $35,000 up to $60,000, enabling first-time home buyers to use the tax benefits of an RSP account in order to access up to $25,000 more for their down payment. Another change is to the amortization rules to allow 30-year amortizations for first-time home buyers purchasing newly constructed homes. It's somewhat restricted in that that amortization change is not going to apply to the much broader resale market. In terms of increasing the housing supply, the government released Canada's housing plan on April 12th, which includes measures to incentivize the building of more housing. There are billions of dollars being unlocked in grants, loans, and other supports and for developers, and changes to zoning and permitting rules to make building quicker and cheaper. Some of the measures are removing the GST on new purpose-built rental projects, an additional $15 billion through the apartment construction loan program, which is providing low-cost financing to build more than 100,000 new rental homes across the country, and over $14 billion through the Affordable Housing Fund, build 60,000 new affordable homes. Another measure relating to affordability that takes a completely different approach is what's known as the ban on foreign buyers. Technically, the legislation is the Prohibition on the Purchase of Residential Property by Non-Canadians Act. This law dates back to 2023 and was set to expire on January 1st, 2025. The government announced that it will be extended 2 years to January 1st, 2027. This is an important act for real estate practitioners to be aware of. And while it doesn't seem to require lawyers to go on a proactive fact-finding mission about whether their client is non-Canadian or not, if information does come to the attention of a lawyer that the client may be a non-Canadian, it's probably necessary at that point to look into the matter further and ask the client a few questions. The Act states that there can be a fine up to $10,000 for counseling a non-Canadian to purchase residential property, knowing that the person is non-Canadian. The key part of that section of the Act is the word knowing. And since lawyers aren't in the business of advising clients on how to get around this type of law, it's doubtful that lawyers are at any risk for a fine. But this provision is a good example of the importance of a lawyer knowing their client and going through the IDV verification process as early as possible in their file, so that if an issue were to arise, there would be sufficient time to manage it. That's all I have with respect to the budget updates, and I'm going to move on to speak about notices of security interest, or for short, NOSIs. This has, for over a year, taken up much of my work as an underwriter because of the impact this risk has been having on owners, lenders, both private and institutional, lawyers, and title insurers. I'll set out what a fraud scheme can look like, and we'll then discuss the upcoming legislation that the provincial government is contemplating. Briefly, a NOSI is an instrument that can be registered against an owner's title by a creditor in order to provide notice that the creditor has an interest in equipment or collateral that's contained within the property. A common example would be a homeowner who gets a new furnace and finances it over a certain period, as opposed to purchasing it outright. The furnace company in that case may then register a NOSI on title to protect its interest in the equipment. The company's interest is different with respect to a NOSI compared to a charge, in that a NOSI is not a lien on the property. It's a notice to any third party reviewing the title, and it helps to protect the interest holder's priority. Now, while a NOSI holder doesn't have all of the rights that a chargee has, in practice, a NOSI can tie up a property in very similar ways to charges and other types of liens. Unfortunately, a fraud scheme developed several years ago in which fraudsters started using NOSIs as a tool to take advantage of vulnerable homeowners, particularly the elderly. As I'm sure many of you have heard, the scheme involved duping homeowners into signing contracts for rental equipment or for renovations that weren't necessary. The amount charged for the equipment or work was always much higher than its actual value. And of course, this was made worse by the fact that the owner had no need for it in the first place. The scheme would often start by convincing the owner to get a new furnace or hot water tank, which is, of course, very standard equipment for a house and might not raise any suspicions at the outset. The fraudsters, though, would then follow up and dupe the owner into getting equipment that they previously never had a need for, such as reverse osmosis water filters, HEPA filters, pest control devices, fancy thermostats, etc. Now, to be fair, I've only seen a pest control device NOSI once, but it was registered in the amount of $30,000. The fraud would sometimes go a step further and turn into outright title fraud, in which the fraudsters would forge the owner's signature on the equipment agreements. After the agreements were either signed or in some cases forged, the registration of NOSIs would soon follow, and almost always without the owner being aware of that. The monthly payments on the equipment were at high interest rates and would at some point usually become too much for the owner to bear, and the fraudsters would then work with a mortgage broker to arrange for financing to pay off these debts. The mortgage broker would show up and sort of hold themselves out as the person coming to the rescue to help the homeowner deal with the debt problem. At this point, once those debts were paid off through the financing, the fraudsters have made money through the receipt of the monthly NOSI payments, which sometimes could go on for years. And then they would make money as well on the payout of the NOSIs through the financing. On many occasions, though, the fraud against the homeowner didn't stop there, and the cycle simply started over. I've seen property titles in which there were as many as 10 to 15 NOSI registrations, followed by a private mortgage to pay them out, and then followed again by new NOSIs, sometimes within a few days. And this was in order to start the fraud scheme all over again. If successful, the fraudsters would come back once the debt of the private mortgage that had paid out the NOSIs and the new NOSIs became too much, and they would convince the poor homeowner to get a bigger private mortgage to pay everything out. Occasionally, these NOSI holders were also the private lenders who were financing the payout of the NOSI debts. But most of the time, the lenders had nothing to do with the fraud scheme, and some of them then would also become victims. The new mortgage would often go into default and power of sale proceedings would begin. And at that point, the borrower would either lose their home or retain counsel to challenge the mortgage's validity and enforceability. And even if the mortgage did not go into default, it's a mortgage that the owner did not need, nor did they ever benefit from those funds. A more insidious version of the scheme, which I've seen, and yes, it's shockingly possible to become more insidious, involves fraudsters owning the property at the end of their scheme. The first part of the fraud would unfold as I just described, but instead of just walking away with their funds from the no-see payouts, they would enforce one of their own private mortgages and sell the property to an entity corporation that they had created, or they would convince the owner that the owner would likely lose the house soon because of all the debts, but they can remain in their own house as a tenant if they sell it now and get the debts cleared up. So it started with these owners owning their houses, usually free of any mortgages, ends up with them losing their house. Essentially a different spin on the typical outright title fraud that we're used to reading about in the news. And this type of fraud is even worse for a homeowner than traditional title fraud, in which the owner would be impersonated by a fraudster who mortgages or sells the property. With impersonation fraud, there's recourse under a title policy or the land title system to have title restored, or in the worst scenario, at least receive compensation for their loss. With no-see fraud, there is typically very little coverage available for a homeowner under an owner's title insurance policy. A lender may have coverage under a loan policy, or it may not need coverage if it's able to enforce the mortgage. Unlike mortgage fraud that stems from impersonation, in which the mortgage is essentially always invalid, a mortgage that paid out fraudulent no-sees is not necessarily a mortgage that's not enforceable, and it very well might be valid. Moving on to a discussion of legislation and where we are now. In the fall of 2023, the provincial government published a consultation paper looking for feedback from any party who wanted to make a submission on this issue. The government reviewed those submissions and has taken them very seriously. In March, it announced that it intends to pass legislation this spring banning all no-sees in the future, as well as retrospectively. Now, what the legislation will actually look like is of course unknown, and the retrospective provision is quite interesting, as that's not something that we commonly see. The government, though, is perfectly within its rights to pass a retrospective law, and that would naturally come with some controversy. So again, it will be interesting to see if they go down that route. From a practice standpoint, lawyers should be on the lookout for this legislation that will hopefully be passed by June, as it may impact the advice provided to clients. For lawyers who represent one of the many legitimate companies who register this type of security, it's probably worth researching alternatives. And for lawyers representing a borrower client who may have been the victim of a no-see fraud scheme, the passing of this legislation, especially if it proceeds with a retrospective component, would have a big impact on the strategy of defending the client's title and how those no-sees might be deleted. So that's all I have on my end, and I know that was a lot of information, but I thank everyone for coming out this morning, and I thank you for your time.
Thank you so much, Brendan. If anyone does have any questions for Brendan, you can put them in the Q&A and we will put them to him at the end of the program. But coming up next, we are going to have a presentation on IDV and fraud and the relationship between those two things. And that is going to be brought to us by Sophia. So Sophia, I hand it off to you.
Perfect. Thank you, Sean. And so I guess staying on the topic of fraud, I think when we talk about fraud, everyone knows someone who's been a victim of fraud or knows someone who knows someone who's been a victim of fraud personally or professionally. And, why is fraud still happening? Why do we keep talking about fraud? Well, fraud has tripled since 2017. I think it has a lot to do with the fact that we live in a virtual world. We're meeting our clients virtually. We are transferring funds quickly, and everything moves very quickly. We're doing a lot of transactions via email rather than meeting our clients in person or picking up the phone and so forth. And so I wanted to touch on a couple of different types of fraud. I'm going to start with social engineering fraud, and then I'm going to go into ID verification, both virtual and in person. And then I had a question from Brendan, who you just heard from, a question from a title insurance perspective. So social engineering fraud, and I think this is a new term that not everyone understands. And what is social engineering? It's a fancy term. And what it really means, it's very simple, and you already know it, which is someone manipulating you or your staff member into divulging confidential information or transferring assets. So usually it's money. And so, simple scenario is you have a real estate transaction closing, you're acting on the sales side, or your client's the seller, and you get an email from your actual client, from their email address that says, really excited, my house is being sold. I'm so looking forward to taking that money and moving to countryside in Italy. And but I've changed my bank account. I can't use the current bank account and I'm in Italy. So here's my new banking information. Can you please confirm that this is where you'll be transferring my closing proceeds? You look at the email, it's from your client. They've addressed you like the way your client always does. They signed off like, your client always does. It sounds like your client. You're like, sure, no problem. You tell your accounting team, transaction closes, you transfer the funds. Sure enough, the real client calls you and says, where are my closing funds? And that's when you realize that the email that came from the client is actually not written by the client. So in this case, the fraudster, quite sophisticated, actually broke into client's email, wrote the email. And when you wrote that email back confirming, yes, I got your instructions, that email actually went to some sort of subfolder. So the real client, the real individual, didn't actually see it. So it's very sophisticated. It's almost like organized crime. This isn't like some, teenager at 11 o'clock at night doing this for a half hour. This is what they do. They watch the transactions. It's quite sophisticated. So if there's anything you're going to take from my part of the presentation, please be aware of fraud, but also be aware of what your coverage is under a policy. This is information we've been putting out since December and throughout this year in different forms. Under your errors and omission policy, your primary policy with LAWPRO, your coverage for social engineering fraud is up to a sublimit of $250,000 per claim and in the aggregate. However, if you take a few steps, including specific information in your retainer agreement, your coverage could be up to $1 million per claim in the aggregate, or $2 million in the aggregate. So we're not talking about buying more insurance. It's taking a few steps to ensure that your coverage is up to $1 million. So I won't be able to get into all the steps, but if you go to our website, and this information is in resources also, the resource material from today, if you go to our website, there's a video that walks you through the steps, also downloadable material, including specific retainer language that you can take and put directly into your current retainer. And that way it ensures that you have more coverage. And who doesn't want more coverage? Apart from doing that, that's about your coverage. But in terms of stopping this type of fraud, we've had a campaign out for a long time about call before you click, meaning, in that situation I just gave you, if the lawyer had picked up the phone call and called their client to say, hey, I got this email, it's from you, but I just want to confirm you're changing, your instructions to us, or is this, did you write this email? The client would have said, I didn't write any email to you today. And then you would have stopped the fraud. Educating your staff is super important because, the buck always stops at us, but our staff members are important in, running the operations, making things go smoothly. So if they can spot something, because we do have busy lives, then at least there's more eyes on the file and more hands on deck. And then educating clients is very important. We all know not to press 1 when we get that phone call that says, press 1 to make the payment for your credit card. But when it comes to this type of sophisticated fraud, clients don't always realize if they get an email from you that sounds like you, they're going to think it's from you, and it might actually be from a fraudster. We also see a bad check fraud, which is when a draft is looks like it's more than what it actually is. So it appears to be more. You put the funds into your account and the same day you disperse funds, and then you find out a day or two later the money that got deposited into your account is far less than what the check appeared to be. And then there's also wire fraud. In Canada, there's two types of payment channels, and in one type of payment channel, the funds that come through, the wire funds, are irrevocable, meaning they're settled. Versus another payment channel, the funds can come through that channel and the funds are in your account, but it's a credit. It's not settled. It could be revocable. So there is a way to verify and take that extra step to confirm that the funds that you have now are not revocable. So they're irrevocable. That's what you want. And just due to time, I won't go into it. There's a fantastic article written by my colleague, Ray Leclerc. It was written in March. Please take a look at the article. It explains the banking system, explains what you should be looking for, specifically the PCRN number. There's previous variations of that, so take a look and don't become a victim of wire fraud. Also, the link to that article is in your resources also. Okay, I want to switch to ID verification all in the context of fraud. And I'm just going to share my screen. I hope my screen's visible. Sean, I hope you'll tell me if it's not. Okay, so this is a flowchart from the LSO. I think it's a fantastic flowchart. For those that practice real estate, if you're receiving, paying, or transferring funds, you will you will always have to do a client verification and then some of the other steps. But if you're not doing real estate, maybe it's something else where this isn't involved, receiving, paying, or transferring funds, you might not need to do these steps. It's actually quite simple. So I think this chart is great to have around, especially if you do more than one type of transaction and practice a different area of law. The second sheet or in this tool is methods to verify ID. I have actually never met anyone that uses option 2, which is credit file method. Sorry, I'm diverting there, but option 4, let's talk about option 4. So I think most people know, and I hope most people know that as of January 1st, 2024, there's a new rule in place about if you're meeting your client virtually, what you need to do. So if you're meeting, excuse me, if you're meeting your client virtually, you need to authenticate their ID. It has to go through an authentication technology. So there's 2 parts to it. And part 1 is taking the ID, it needs to be scanned, and the authentication technology does its magic. It looks at the features on it and then confirms if it's true and genuine, meaning doesn't look fraudulent. And then the second part to it is confirming that the person who's presented this ID, the person you're meeting virtually, actually is the person in the authenticated ID. Now, either you can do that or the same technology can use biometric technology and compare the features of the individual and compare it against authenticated ID and confirm that, yes, it's the same. So those are kind of the 2 things that has to be done. One of the questions that was asked quite early, like in December, but also January and February, and I think most people have figured it out, is where are they going to go to do this? What authentication technology? What are the service providers? The Law Society has a link to DIAC, and DIAC now has a very short list, but initially the list was quite long. And while we can't, LAWPRO can't necessarily recommend a service provider, what we did is we sent out a survey, and I'm just going to flip to the next screen. We sent out a survey with a bunch of questions and asked these service providers if they want to participate, they can answer the questions. And we took the answers, their exact answers, and put it into a spreadsheet. Now, this is my screenshot, so there's a lot more columns vertically and horizontally. And, disclaimer, we didn't verify the information and we haven't kept up to date. So unless the service provider has reached out to us, it is what it is. It was done at the end of January and February. It's still a good place to start if you're still trying to figure out, like, you don't like one provider, you want to switch to another. I know a lot of you would use the one that wherever the title insurer, whichever one the title insurer says, but if you're opting on the sales side, you might have some room there. So if you're still looking, you can take a look at the spreadsheet, but please do your own due diligence. Just gonna take off screen share. Okay. Sorry, I just lost my train of thought. Okay, so that's virtual ID verification. What I've been hearing is that now more clients want to come in person, and it makes sense because not everyone is tech savvy. I know there's sometimes hiccups when you're doing virtual ID and the person has to like move from one room to another room. It's too dark in one room, or they might not be comfortable uploading their information to a third-party service provider. So now you have people coming in person, and I know some people have expressed this. Now, in-person ID verification hasn't changed. But as a reminder, you have to do something. It's not as my colleague says, a copy and file exercise or scan and file exercise. I don't know how many people actually photocopy anymore, but it's not just like you look at it and you put it away. You have it on file. You have to do something. There are like some simple ways of, you're not an ID expert, but for example, if I'm looking at my driver's license, I know generally what my license looks like, and I know generally what my Canadian passport looks like. So if I'm looking at somebody's ID, and I know my height in centimeters, and I know what that looks like on my license, if I'm looking at someone's ID, and the person in front of me is 6 feet tall, but it doesn't make sense on how tall they're on the driver's license, that should be a red flag for me. Or they're smiling in their picture. Most of us know in our government IDs, we don't smile. Or you're looking at like a passport and a driver's license and the picture's identical, but one's provincial, one's federal. I don't think ever those pictures would be the same. So those should be red flags. So you have to, it's not just getting it for a file. You have to do something. So I think I'm right on time. I'm going to pause there, and I had a question for Brendan. Brendan, if you want to come back on screen. One of the questions that I got, actually I got it more than once, where the seller's lawyer has asked, like, what the question was the buyer's lawyer is asking for the IDV report, the virtual ID verification report. And, initially I was like, okay, why they're asking for it? It's because the buyer's title insurer, prior to closing, is asking to see the seller's IDV report, or they're asking for additional information. From a title insurance perspective, can you elaborate on why they might be asking for information and what are they looking for?
For sure. So the title insurers would be asking this question if when underwriting the owner's policy that they're being asked to issue, there's something about the deal that gives them sort of pause and they need to dig a little bit deeper. So, for example, it could be a large transaction, let's say 2, 3, 4 million, and the property does not have a mortgage, and the title insurer at that point is at risk of the full policy amount that they're insuring if a fraud were to occur. So in that case, the title insurer would want to take a look or would want to know if the IDV report had been done. And if so, they may want to see a copy of it. The seller's lawyer, of course, is not under any obligation to share that, but sometimes, depending on how the transaction is going, they may choose to just to help things proceed. The title insurer might review that, or if they don't, either way, they still might have some questions for the seller's lawyer to try to help them get comfortable with the transaction that they are reviewing. So they may want to know, for example, how well the seller's lawyer knows their client. And if the answer is that the seller's lawyer knows the client really well, that will essentially end any concern from a fraud perspective, and there likely won't be any further questions. If the lawyer had just met the client, then further questions might come, such as, The issues that might be paid attention to is where are the mortgage funds going? Or sorry, the purchase funds, are they going directly to the seller? Is there a possibility that they're being redirected to a third party? That's an indication of fraud, but in most cases that would not be fraud. So for example, there may be one person on title, but it's a matrimonial home. There's a couple who is separating, and the funds are being paid to the spouse's, the non-titled spouse's family law lawyer. That's a perfectly reasonable explanation, and a title insurer in that case wouldn't be concerned that funds are being redirected to a third party. If there are questions or if there's something unusual that's happening, again, that doesn't mean that there's a fraud, but it's an indication that that there could be. And again, further questions might be asked, such as, was there a deposit paid directly from the purchaser to the seller? In most cases, a deposit's going from the purchaser to the real estate agent, occasionally to a lawyer to hold in trust. So if there's a deposit directly from purchaser to seller, some questions might be asked to see if there's a way to get comfortable with that. For example, do the seller and purchaser have a long-standing relationship? And in that case, that would make sense. Another question that might come up is, even if funds are not being redirected from the seller's lawyer to a third party, is there something else that's maybe a little bit unique, such as did the seller ask their lawyer to cut 5 checks to the seller? Did the seller's lawyer ask the seller's lawyer, did the seller ask their lawyer to wire the funds to 3 different bank accounts? So those are the kind of things that title insurers might be asking and might be trying to work through.
Perfect. Thank you, Brendan. I had a couple more questions, but I think we're at time. So I think, Sean, I'll turn it back over to you.
All right. Thank you very much, Sophia. Thank you, Brendan. And we'll hopefully have a little bit of time at the end to wrap up with some questions on that topic as well. Next, we're going to hear about CRA's new trust reporting rules. So I'd like to invite Zara onto the program to speak on that subject. Zara?
Thank you, Sean. Thank you for having me on the program today. I've already learned a lot from the previous presenters, and I hope that I have something to share with you today. So around fall of last year, I started getting a number of phone calls, emails from clients saying one of 2 things. The first thing was, you know that trust agreement we have? Do you have a copy of it? And then the other thing was, can you get me off title to this property? So I had, for example, a lady call me. She was on title to a downtown Toronto condo with her sister. Her sister was the only beneficial owner of the condo. She'd only gone on title about 15 years ago when the property was purchased because she was co-signing her sister's mortgage. And now the property was mortgage free. There's no need for her to be on title, and she wanted to come off. That's all understandable. But the question that I kept asking clients was, why now? You know, you've had this, you could have come off before. Why are you choosing to do it now? And consistently, I got the same response: the new rules, the new rules, the new rules. So what are these new rules, and how have they impacted real estate lawyers and, you know, created all this flurry of activity in the real estate law space, which you wouldn't necessarily expect from changes to the tax regulations? Before I get into sort of the nuts and bolts of that, I want to give sort of an overview of the way in which the Income Tax Act, the ITA, deals, at least on a conceptual basis, with trusts. So we know that the ITA deals with various taxpayers. So we have corporations, and then we have non-corporate taxpayers. And under that non-corporate taxpayer category, we have natural persons such as yourself and myself, or we have trusts. And the ITA does not tell us what a trust is. There's nowhere in the Act that you can go and look up a definition of a trust. It, I think, in its wisdom, leaves it up to the underlying private law of your jurisdiction. So whether that's the civil law in Quebec or the common law elsewhere in Canada, to make the determination of what a trust is and when it has come into existence. But so far as the Income Tax Act is concerned, if you do have a trust, then there are certain provisions that will apply to you. Those provisions can be taxation provisions, and they can also be reporting provisions. And if you take a look at those provisions across the board, you'll see that one reason why the ITA is concerned with trusts is that it sees trusts as exercising control or power that is independent from the control and power of the beneficiaries. So from that, it follows that if you have a situation where the trustee is not exercising any control or power other than specifically as an agent for the beneficiaries, then the ITA does not deem that arrangement as a trust. Specifically, there's language in the Act that's helpful. I'm going to read it to you. A trust is deemed not to include an arrangement under which the trust can reasonably be considered to act as an agent for all beneficiaries under the trust with respect to all dealings with all of the trust's property. And then it goes on to say that a trustee can reasonably be considered to act as agent for a beneficiary when it has no significant powers or responsibilities. It can take no action without instructions from the beneficiary, and the trustee's only function is to hold legal title to the property. So this language reminds us of something that we have a word for in real estate law and also in tax law, and that is the bare trust. A trust where the trustee has no power, its powers are bare, right? So although the ITA does not tell us what a trust is, it tells us what a trust is not, and it tells us a bare trust is not a trust. And that's relevant when we get into sort of the impact of the new reporting rules on real estate law practice. The other really important thing to note about the new rules is that they do not change the way in which tax treatment of trusts takes place. So the way in which trusts were taxed in the past, that has remained the same. What has changed is the reporting of trusts, what they are required to report. And the new rules came to the fore in the 2018 budget. They came into effect in 2022, and the sort of first taxation year where they became relevant was the 2023 taxation year. So on or after December 31st, 2023, there was a requirement for trusts that are captured by the new rules to make filings. Okay, the government sort of released some information about the rationale behind these new rules. And what we know is that there was an effort to bring more efficiency and integrity to the Canadian tax system. There was a hope that these new rules would help the authorities to prevent aggressive tax avoidance, tax evasion, to avoid or to sort of crack down on money laundering and other criminal activity perpetrated through these vehicles. The government's trying in these new rules to get information that would enhance transparency. So it wants to know how trusts are being used, who is creating them, who these trusts are benefiting, and who controls them. They care about the Canadian trust, but they also care about non-Canadian trusts that would be subject to the Canadian taxation provisions of the ITA. The new rules basically require for additional information to be provided about income and also about the stakeholders of trusts. Under the new requirements, there will be significant penalties for trusts that are captured by the new rules that fail to comply with them. So let's get into the new rules. Before the new rules were brought into place, the taxation reporting rules basically outline two exceptions. So if you were a non-corporate taxpayer, including a trust, and you did not owe any tax under the Income Tax Act for a certain year, you did not dispose of capital property or realize a taxable capital gain during that year, and you did not have a positive balance in your home buyers or lifelong learning plan, then you were not required to report under the Income Tax Act, and that was referred to as the general exemption. In addition to the general exemption, since according to the ITA, bare trusts were not deemed as trusts, there was another exception, the bare trust exclusion, that said, if you're a bare trust, since we don't think you're a trust, you don't have to report, okay? The new rules have effectively reversed both of those exceptions. So now, trusts that are residents in Canada, and if they're not Canadian trusts, they're foreign trusts that are deemed to be resident in Canada, and they are express trusts, they no longer benefit from the general exemption unless they fall under a limited set of listed trusts. So there are 15 of those. You can look them up. They include things like the trust is a charitable organization, or it's a trust that exists under an RRSP or a TFSA, things like that. Unless you fall under one of those exceptions, you're no longer exempt, even if you don't have any tax owing, and if you don't have capital gains that are taxable in that year, you still are required to report. And the exception there was for bare trust has also been removed. So the new rules say that although the ITA does not deem bare trust as trust, for the reporting requirements, we do deem them as included in the new reporting rules. So a trust that is captured by these rules is now required to file a T3 return. And in addition to the T3, there's a Schedule 15 called the Beneficial Ownership Information of a Trust. And both of these in conjunction operate to provide information about all the trustees, the beneficiaries, the settlers of a trust, and anyone who has the ability to exert any power to override the trustee decisions over the appointment of income or capital of the trust, so a protector, for example. And all of this information needs to be communicated with respect to the stakeholders, and that information would be their name, their address, date of birth, their jurisdiction of their residence, and their tax identification number. Things that in the past, the government really had no access to. Failure to comply with these conditions has, as I mentioned, significant penalties that attach. So there's a late penalty of $25 a day, a minimum of $100, and a maximum of $2,500. And if a trust is found to knowingly or as a result of a gross negligence fail to file a return, there is an additional penalty of the greater of either $2,500 or 5% of the maximum value of the property of the trust property during the taxation year. So for example, if you have a bare trust that is entitled to a cottage property, and we'll get into how that can come about in the real estate law space, then if you're found to be subject to the additional penalty, you're looking at $50,000 on a $1 million cottage. That's not little money. In fact, the whole sort of impression about these new rules is that they were a lot. They were a lot for taxpayers, normal Canadians walking down the street who had gone on, a bank account with their mom or dad just to help them out in paying their bills. And it was a lot for tax practitioners. So a lot of accountants, tax advisors, lawyers were really struggling under the burden of these new rules. And to its credit, the Canadian government recognized the struggle, and it released just before the deadline for compliance, I believe 4 days prior to the deadline, an announcement that there was going to be transitionary relief specifically for the Bear Trust requirement to report, and specifically for the 2023 tax year. What they've said is that, and I'm going to quote, over the coming months, the CRA will work with the Department of Finance to further clarify its guidance on this filing requirement. The CRA will communicate with Canadians as further information becomes available, and we all patiently await that information. So what does all of this mean for you, the real estate law practitioner? And I think we've all seen Bear Trusts in one shape or form across our practice areas, whether it's, you know, the typical mother wanting to help her daughter become a homeowner, so she co-signs on the daughter's mortgage and has to go on title to the property that's being purchased and becomes a Bear trustee for the daughter with respect to that property. So, you know, a typical example. Or, for example, if you have a developer client wants to take title to the development site through a corporation that shields the developer, him or herself, from being publicly associated with the site. For whatever reason, you know, people want to maintain privacy, so they will use a Bear Trust to take title, because those title documents are public and they're publicly searchable. It's a means of protecting privacy. Another place that we see Bear Trust in the real estate law arena is when you have a minor child and you want to gift that child a property, but you cannot, you know, have the child take title. You put the title of that property into a Bear Trust until such time that the child comes of age. We've seen Bear Trust being used by, you know, husband and wife who have over 20 years accumulated a modest portfolio of rental properties, and they've, you know, had their personal names, but now there's 7 of them, and all of the money's coming in and going out of their accounts, their personal accounts, is just too much to manage effectively. And so they put the properties into a Bear Trust, a corporation that they have created just for this purpose, and it has its own bank account, so everything can go through that bank account, bookkeeping, and, you know, they're still responsible for the tax consequences of those investments, but things can become much more organized by having the Bear Trustee take title to those properties. And I've had that, you know, happen multiple times with clients. It's something we see happening all the time. Another final example would be if you've got, if you deal with corporations doing reorganizations, you're going to have a situation where property might need to change title from one corporate entity to another multiple times before the reorganization is finalized. And instead of doing that, you can put the property into a Bear Trustee name and then do the reorganization that you want when you want, so you're not sort of constrained by administrative timelines, and then have the Bear Trustee transfer to the final corporate owner at the end of the reorganization. So in all of these instances, whereas before we just, you know, really focused on the real estate law implications of those, now we also have to turn our mind to this additional requirement that the Bear Trust, when it comes into existence, will have to comply with the reporting rules. It doesn't have to comply this year, but it's very reasonable to expect that the requirement will be brought in the very near future. And so from a real estate law perspective, there are 2 things. One is when you're creating the Bear Trust, making sure that the client knows that one of the additional, you know, risks and also costs of taking that route is that there are these additional requirements and the penalties that would attach for non-compliance. I wouldn't go so far as to advise the client on the specific obligations of exactly what they have to do to comply, unless I also practice in tax law, which I personally don't. I would refer them to a tax advisor that could give them that specific advice, but I would make sure it's on their radar that this is something they have to deal with. And if a bare trust already exists, so it's not about, doing the calculation of whether the benefits outweigh the risks. If they already exist, just making sure that the client is aware that what they have created has this nature, and therefore they can deal with the consequences that come with having a bare trust. When they don't know, when something's been created in the background, say in the example with the mother helping her daughter with the co-signing of the mortgage, she really cares about that mortgage getting funded and that house closing and popping the champagne. She's not really bringing her mind to the fact that in the background, what we've created by doing all of these things is a bare trust, and she's not really diarizing, file my T3. And so it's really my job to explain to her that what we've done has created this creature, and there are going to be consequences, and you need to educate yourself on those consequences. And that, I think, brings me to some sort of practical best practices. We've heard time and again that you need to limit your retainer. If you're not giving tax advice, it needs to be in the retainer. If you're not going to be doing tax filings and the client's responsible for that, you need to make sure you commit that to writing in the retainer. And then we also have constant reminders, and rightly so, that our reporting letters should be specific. They should cover, I've told you about these, tax consequences. I've given you this tax advice if you have given it, or I've told you to seek out tax advice if that's the route that you've taken. But I think above and beyond that, it's if you have, and I think one of the big takeaways of my presentation is that you should be educating your clients on sort of the background structures that are being put into place. If you have done that, it makes it's so much easier for your client for you to provide a synthesized form of that explanation in your reporting letter, so that whether it's 5 years or 10 years down the road and they're looking at the reporting letter, they can read that and they can say, oh, I understand what I've created is the bare trust. And they can go out at that point in time and look at what their obligations would be as a trustee under a bare trust, as opposed to saying, I've told you to file the T3, 10 years down the road, they're going to look at that and it might not make sense to them, might not even be relevant. And if that's all you've put and you haven't really repeated, that educational piece, then they're going to be left clueless as to what's going on and what their obligations would be. So that would be my big takeaway for that. Thank you so much.
Thank you so much, Zara. And for our final subject today, I'm going to invite Mark Jeffadoni on to speak on the subject of tax must-knows for real estate transactions. So Mark, if you're there, I will defer to you.
Thank you, Sean. And thank you for inviting me to speak here today. I'm picking up on a few of the themes that we just heard from Zara about tax-related issues and real estate transactions, really with a focus on understanding and communicating the scope of your engagement with clients on tax issues, issue spotting, getting comfortable being able to tell your clients where you draw the line on tax advice, explaining how complicated it is, how frequently tax rules change, and how you really need to get really factually involved with your clients to be able to provide meaningful tax advice. Then we can get into some examples of typical real estate tax interactions that you may find in your practices and how to potentially navigate them with your client. The scope of your retainer on tax needs to first start with an assessment of your own competencies. The ability to provide tax advice can come off very off the cuff. It might be a yes or no answer, but yet it's still considered tax advice and even potentially a tax opinion. And so you should understand from yourself whether you're competent to provide that, whether you've had enough interactions with the scenario in order to be able to provide that advice to the client at that particular time. So document in an initial letter the scope of your retainer and defer tax issues to a qualified expert if that's not you. That could be a financial advisor, a tax lawyer, an accountant, but document it and set it out. And then don't give the tax advice. So if you are competent to provide tax advice in a very certain specific way, then you can say as much. You should say as much, but don't exclude it and then provide the tax advice afterwards. I invite you to go and have lunch with a tax lawyer. Get a feel for their practice, what it entails, what they do on a day-to-day basis, how they handle tax advice, how they deliver tax advice. And if that's not what you're doing, then I think you should keep their number handy as a good referral source. The practice involved in proper tax advice does not necessarily mirror the frequency, the chaoticness of a traditional real estate practice. Understanding how the practice points differ from a tax practice is also a helpful idea. Focus on issue spotting, getting familiar with facts and context within the transaction and where those tax issues are likely to arise. Are the parties individuals? Are they trusts? Are they corporations? Are they partnerships? Dig into the details behind that and understand who is involved here, because that will impact a tax implication. Have a focus on the residency status of those parties. Are they citizens? Are they permanent residents? The notion of residency is a complicated item. You can lose the residency by being out of the country for a period of time. So asking questions about the residency status becomes quite important in being able to spot if a tax issue is arising. How has the property been used and how is it actively being used? Is it a mixed use? For residential properties, are they long-term residential, short-term residential? Are they multi-residential properties? Are they rented out? Are they not rented out? And then ideally for other components of the property, is it vacant? Is it agricultural in nature? Has it been subdivided? And ask those questions. Ask lots of questions to get a sense if tax advice is proper in the context, if you should refer them out to a specialist. Commercial real estate has lots of tax issues hiding around every corner, and they should be referred to tax specialists for additional content. In many cases, the transaction that you're working on is part of a larger corporate project, restructuring, and so you may be part of an already existing planned tax strategy. Find out. Don't get caught off guard that you're, I was told to put property into this person's name. Why? Explain it, get involved, and understand your role in the transaction. Intergenerational transfers and succession planning has lots of tax issues, specifically for the seller or the donor, but it also has a number of tax implications for the buyer, the donee, the recipient of a gift, if it's a gift of real property. So understanding not only the intention of the transferor, but to identify that there are significant tax implications on the people you want to gift this to. Have they had tax advice? Do they know what they're in for? Ask those questions. And if you're not able to provide the comprehensive tax advice, refer it out. The same set of facts that are applied under one tax regime may not have the same tax consequence under a different tax regime. Just because there's an exemption, a deferral, or a credit for something like HST, there may still be an income tax or land transfer tax obligation under the exact same factual scenario. So you can't assume that the facts carry over and have the same tax treatment. Read the tax statute. That's kind of an easier one, but I mean, they're tax statutes, so they're inherently technical and horrible to read, but refer to the tax statute, particularly if it's one that you're somewhat familiar with. Don't rely on interpretation bulletins, public commentary, articles, or unofficial guidance. Those can help with context. They can help orient you to the right frame of mind for your facts, but they're not necessarily authoritative. So get a sense of where you should go from there, and then read the tax legislation. The tax rules change frequently, and just because it was set out a certain way the last time you did the similar transaction, it may no longer be the case. You'd be very surprised at how sometimes these changes happen with very little fanfare, very little public disclosure, and sometimes improperly or without the proper level of thought in how the trickle effects may impact day-to-day transactions. So looking briefly at a number of scenarios of tax regimes that might impact a real estate transaction in the normal course, non-residency and withholding tax obligations is one under 116 of the Federal Income Tax Act. A non-resident vendor needs to produce a clearance certificate from Canada Revenue Agency with respect to how much tax is owed or payable on a sale by a non-resident, failing which the purchaser is to remit either 25 or 50% of the purchase price, depending on the nature of the transaction, to Canada Revenue Agency by the end of the month after the transaction occurred. Many lawyers want to flip this and have the vendor hold all of the funds until the certificate's issued, or, well, if that's the case, it could be significantly longer given CRA issuance timeframes. But that puts a liability on the purchaser and the purchaser's lawyer if funds are not sent in the right way. Interest penalties accrue, and CRA can go and pursue any of those parties for failing to remit it in the proper way. So check your undertakings, your contractual obligations, your agreements of purchase and sale, and see how that has been structured in a meaningful way so as not to impose undue liability. With withholding tax and the sudden nature of things, there's a Tax Court of Canada case that came out last year, kind of under the radar, that suggests that withholding taxes are payable by tenants on rents if their landlord is a non-resident landlord. Lots of head shaking going on there. How is a tenant supposed to know that? How does that work? So there's still some commentary in connection with how that should actually unfold. These tax issues are current and changing very significantly, and if you're not attuned to them regularly, you shouldn't be providing the advice. Non-resident speculation tax is in Ontario. It's an Ontario tax. It's currently set at 25%, collected under the auspices of the Land Transfer Tax Platform for non-resident purchasers of residential real estate, at least 1 to 6 residential units by individuals who are not permanent residents or Canadian citizens. And that includes foreign corporations and trusts with foreign national control or beneficiaries. The exemptions are pretty difficult to navigate, and the tax regime changes every so often. Either the rate changes or the exemptions change. So being astute in terms of how that might impact your transactions when you get them in, it's important. There is the federal prohibition on the purchase of residential property by non-Canadians Act, which actually isn't a tax act, but it prohibits non-Canadians, again, it's different from non-residents, from buying residential property. But that prohibition does not actually speak with or speak to the circumstances around the non-resident speculation tax. There may be an exemption under the federal legislation, but still imposes a tax obligation under the provincial regime. Understanding how those facts intertwine and impact each other is important to understand if you have a non-resident buyer. HST, or the harmonized sales tax, I hate this tax a lot. It's very technical in its application, very heavily fact dependent. The smallest fact tends to shift things significantly. HST in real estate transactions can get pretty complicated. Generally, it's applied based on how the vendor last used the property. The purchaser's intended use of the property doesn't carry a lot of weight in terms of assessing HST. Short-term residential real estate does attract HST. Long-term residential real estate, so leases of 30 days or more, does not attract HST. Vacant land could be HST exempt based on a number of factors. And so you should be aware of what those factors are and how they impact factually into your scenario. Otherwise, the parties could have a surprise HST obligation due on closing. And for that reason, read the contract. How has HST been allocated in the purchase price? Does it actually allocate between building and lands, parking lots, chattel property that's included? Is HST embedded in the price? Is it in addition to the purchase price? Is it silent on what happens with HST? All of these things you do not want to be running around trying to figure out 45 minutes before closing. And so trying to read the contract and set out in detail what the obligations are is really getting ahead of the curve. Who pays the HST? So purchaser pays to vendor, vendor remits HST. However, sometimes purchasers can be registered under the Excise Tax Act and can set off HST obligations against their other obligations. So self-assessing and reporting to CRA directly. In that scenario, there's an exchange of a certificate and indemnification, which tends to work in most cases. But sometimes you get the advice that says, well, if you have an HST number, you don't pay HST. That's not necessarily the case at all. So understanding not only the advice that you're giving, but the context in which it's given very much helps to get it right and make sure that the parties are reporting and remitting in the right way. For new home construction, HST is another consideration, as there's a rebate component that's usually built into the contract. Read the contract. Typically, the purchase price includes HST, but assumes that the buyer qualifies for that rebate. And so if ultimately the buyer does not qualify for the rebate, that tax is paid as part of the purchase price. And sometimes builders will require the full HST obligation to be paid on closing and let the buyer go and apply for their credits or rebates after closing. Increasingly, that is starting to be seen to avoid the confusion associated with assigning transactions before closing and upgrades that push contracts well outside of the operation of rebate qualification thresholds. Land transfer tax, most real estate lawyers should be familiar with land transfer tax and the manner in which it's calculated. While there are a number of tools associated with helping you figure out and calculating the tax, in many cases, the value of consideration becomes an issue, and also whether an exemption applies to the land transfer tax itself. Value of consideration can be more than just the value of the purchase price, and you see that on new home builds often. So the consideration that's paid is the value of the land and the building, upgrades, adjustments for services, or the assumption of liabilities. So things like free appliances or the tree planting charges can be added into the value of consideration for the purposes of land transfer tax. But there shouldn't be tax on the tax. So if there's HST embedded in those prices, that should be excluded for the purposes of looking at value of consideration. So there needs to be a considerable way of looking at the value of consideration to determine the tax obligation. For a gift to be exempt, it has to be a true gift. Was there an intention to gift? Was there an acceptance? No consideration given, and was it actually delivered? So if the donee is getting a free parcel of land, but at the same time is taking over a mortgage obligation, the land transfer tax applies to the value of that mortgage obligation being assumed. You can't assume that everything is for free these days. Vacant land taxes, they're currently in Ottawa and Toronto, and Hamilton will have one next year. It's a vacant unit tax based on 1% of the assessed value of the property. That 1% can fluctuate depending on the jurisdiction. There are limited exemptions on the jurisdiction-specific bylaws that create these vacant land taxes, whether the owner has died or transferred the property to a non-arm's length property in a tax year, the owner has left for a hospital or a long-term care stay, or there's renovations to the house preventing occupancy. Certain exemptions do apply. But in most of those scenarios, there's an active obligation on every homeowner to file a declaration as to the vacant status of their property, failing which the property is deemed vacant. So buyers will usually require evidence of that filing and how it impacts the normal due diligence in a real estate transaction. Federally, the government imposed an underused housing tax as of January 1st, 2022 that has similar undertones to the municipal ones. It does not require a declaration to be filed, but there are remittance and reporting deadlines that have been deferred twice, and legislation pending that will soon modify this tax as well. Capital gains taxes, I won't get into that in a lot of detail because a number of our speakers have outlined the changes to that and the implications. But the main point is to understand that the capital gains tax is related ultimately to the income attribution to the party that realized on the gain. So understanding that party's general tax scenario and what their income might be for the year impacts their ability to determine whether a gain, the calculation of the gain and the amount of the gain, all of which is tax advice that should be referred to a specialist that's familiar with their other income and tax status. Similarly, on a gift of property, for example, asking about whether the recipient will have a corresponding tax implication receiving a cottage property from a parent, for example. Those are all going to be impacted on the ability to give tax advice. So the main points to consider when you are up against a tax question, or you can see for the nature of the transaction that's happening that there are tax implications, unless you actually are a tax professional in that area of tax and you're competent, you should exclude the tax advice from your engagement and don't provide the tax advice. Do refer them to a legitimate referral source who they may be familiar with and certainly who you should be familiar with. Report what you have provided. If you did provide tax advice, report that advice and the factual scenarios around the giving of that advice. The reporting letter is going to be helpful in terms of what actually happened, but to say I provided this advice and that was the tax advice without the context may actually be a challenge trying to determine if that was even prudent at the time that the advice was given. Tax regimes change very frequently, so having your reporting letter to document that is a really excellent way of moving it forward. Things like land transfer tax, property tax are often tax regimes that most real property lawyers should be familiar with. HST and income tax tend not to be, so feel free to acknowledge where your limitations are and be upfront about that. Read the tax legislation each time you have to get involved, just to make sure that it hasn't changed in a material way. And read the agreement to see how tax implications may be handled. The who, what, where, when, and why, and how of the tax implications are usually somehow guided by the contract. And if they're not, you want to raise it at the outset that you're going to be able to address those, hopefully amicably between the parties. And ask lots of questions. Get comfortable with the facts. Explain to your clients that this is not simple. This is not routine. It's not rote. It's not law by numbers. Real estate practice is complicated. It involves many factors, many areas of the law, tax is but one of those, and that to get the answer right, it requires some thinking, some due diligence, and some investigation. So don't feel discouraged by being able to ask lots of questions to your own client and let them get the advice that they truly need. Thank you very much, and I'll return it back to Sean.
Thank you so much, Mark. So that brings us to the end of our program. We do have a few minutes left here to have some questions. So I would like to invite Brendan to turn on his camera and come back for a couple of quick questions that follow up on what he spoke about. Brendan, first of all, I got a quick question for you. Does Title Plus have market value endorsements?
So at this time, that's not an endorsement that we have, but that's something that the team has been talking about over the last few months, and something that we're going to look at rolling out soon enough. In the meantime, for any insured owner who has a Title Plus policy, it's definitely possible to increase the amount of insurance, so that if the policy is several years old and the insured or their counsel thinks that more coverage would be helpful, especially in the event of a post-policy fraud, then that's something that Title Plus can do. We can increase that policy amount for the owner.
Okay, and I have another question for you here, Brendan. This question is just asking you to perhaps clarify and elaborate on something that you said in the program. You spoke about how capital gains are taxed in corporate hands and how that compares to the gain in individual hands, and whether that is only the gain in excess of $250,000. So if you could maybe just reiterate and elaborate on that statement to clarify it.
Yes, so the change increasing the inclusion rate from 50 to 66.7% applies at as of the first dollar for corporations and trusts. So that any capital gains realization is taxed at that higher amount. For individuals, the tax change regarding the increase kicks in only at $250,000. This week, the government decided to put the capital gains tax change forward in a separate bill, and it's not being included in the budget bill. So some of the details might still or are still likely to I guess be up for review in detail.
Okay, excellent. Thank you, Brendan. I'm going to invite Sophia on now to answer a couple of questions on her topic. First, I just want to say one quick thing. We did get a few questions about people asking about how they can go about obtaining the PCRN number for wire fund transfers, and how long they have to wait before EFT funds, electronic fund transfers, are irrevocable. Unfortunately, the disappointing answer for that is that we do encourage you to speak to your branch manager or account manager at your bank. LAWPRO has been speaking with Payments Canada and the national banks and everyone involved in this process to encourage greater transparency and greater clarity from the banks about how lawyers can get this information, how they can get metadata so that they can rely on the funds that they are seeing in their account. Unfortunately, we do know some lawyers are still having trouble getting that information. And although there is progress being made, we understand that sometimes you have to kind of pester the banks a little bit. And so that's unfortunately the best answer I can give you at this time, but that information is there. And we do know that there is some better transparency coming, and there is growth and change in that regard. Sophia, now I'm going to just put the next point to you here. We do have a couple of questions about what you were speaking on, specifically with regards to ID verification. This question says, does ID verification apply to retainers where the lawyer will receive only a legal fee? And second part of it is, can the authentication tech under option 4 be applied to foreign IDs?
Yeah, so the answer to one is, if it's just for fees, no, it actually, under that chart that I was showing you, falls under the exemptions, right? So if it's just for fees coming in for your legal fees, then you don't have to go through the additional steps, including verifying ID. Authentication technology, from my understanding, depending on the service provider, does work for foreign IDs.
And the next question I have for you, Sophia, is if you've recently acted for clients and met with them personally and copied their ID prior to Jan 1 is the specific detail in this circumstance, and you're doing another transaction, can you rely on the previously received ID if it has not expired?
Yeah, so the Law Society in their FAQs actually has a great answer for this. And my understanding is if you don't have to do ID verification again and you're not doing ID, then that's fine. But if you have to do ID verification, which is generally we do it on every single file, and if it's post January 1st, 2024, and you're meeting them virtually, then yes, you have to do it through the new process, which is authenticating your ID.
Thanks, Sophia. There is one other question that I'll quickly address. Someone asked to clarify where they can get the suggested retainer language for the increased coverage from 250 to 1 million when dealing with social engineering circumstances. The social engineering toolkit is available on practicepro.ca, and there's a link to the toolkit at near the back of the program materials on our page of additional material links. So you can get there through either of those routes, and you will find the suggested retainer language in those materials that we have put forward to address the requirements. I think we have time for one or two more questions, and I'm going to put this to Zara. Zara, if you can turn on your camera very briefly. So give me 1 second. I got to find the question. So the first question is there was two questions that were along the same lines, and is there an obligation to update your clients or past clients with regards to these new reporting rules with regards to their existing trusts if there isn't any new legal advice being provided?
I don't think that there's an obligation for you to provide this advice. But I think just from a best practice point of view, it would be helpful for clients to receive a newsletter that sort of outlines here's what is coming down the pipes. If you have a bare trust, for example, this would be relevant to you, and if you need more information, you can reach out.
Thanks, Zara. And one more question for you. For new CRA trust reporting requirements where multiple buyer deposits are held by the vendor or builder's lawyer in an interest-bearing trust account under Section 81, does the vendor have to include information for buyers in the report? And then going on, the question says, do buyers qualify for any of the categories for reporting purposes such as trustees, settler beneficiaries, or controlling person?
Okay, that's a great question. I'm not going to provide a substantive answer because I was listening very carefully to Mark. And I'm not a tax lawyer. So that is a question that you would pose to a tax lawyer, but I do have some general guidance on that. And the first thing is there is an exemption generally for lawyers' trust accounts. But if the lawyer's trust account isn't a general account, it's a specific account for a client matter, then the exemption doesn't apply. So that's the first thing that you need to know. The second thing is there was a specific question that was put to the CRA about information being disclosed in the process of the reporting that would violate solicitor client privilege. And on the CRA website, there's a written response that the new rules do not require the disclosure of information that is subject to solicitor client privilege. So far as providing information about clients would sort of go contrary to that, you have the protection of that, and the CRA has been very clear on that position. In terms of the substantive answer, definitely call a tax lawyer and get that advice.
Thank you so much, Sarah. Now, unfortunately, we are at time, so we are not able to answer every single question, but thank you to everyone who attended this program. As a reminder, there is a link to a survey in the webinar chat right now. We would encourage everyone to please click on the link and fill it out because the information that you provide us really helps us improve our programs for the future, give you the topics that you're looking for, and help deliver the material in a way that is optimized for all all of the lawyers. As a reminder, this program is valued at 90 minutes of CPD material for professionalism, and it is also worth 1 risk management credit, which is worth $50 on your next LawPro insurance program. All of our previous programs are available on demand at practicepro.ca/CPD, and so you can go onto that website and find videos of all of our past programs for free. And this program will also be available there starting next week at some time. And so you can view this program on demand and review the material that was covered at that time. Thank you again, everyone, for coming. Thank you to our presenters, and thank you to the TLA for helping us host this program. This is the end, but we will be having future programs coming up later in the year, so keep an eye out for that. Thank you.